Hello friends, input tax credit on closing stock. We'll just literally run through the provisions, because in spite of all the confusion that is there over these provisions, effectively it's very simple as far as understanding the act is concerned. Section 143 of the GST Act very clearly specifies the various scenarios that can emerge, and we have tried to analyze the same here. So this is Anurag, and I'm here on this channel to share the little that I know. Please subscribe to this channel to keep following me. There are various segments that we've covered here. So one is how the current tax duty structure compares with that in the GST scenario. Now what will happen if I have stock in hand which is within 12 months and I have duty invoice which is available? What if I have stock in hand within 12 months but I do not have duty invoice? So there are two scenarios. Stock is within 12 months, A invoice is available and B invoice is not available. And the third scenario is that the stock in hand is before 12 months, so it is immaterial whether invoice is available or not available. And then we have the section 140 subsection 3 on the GST provisions. Now if you look at the pre-GST scenario, what used to happen is that I had my X factory price at 100, used to charge excise duty at 12.5. For the sake of simplicity, we are removing the cess part, and the combined part of this was the base for excise VAT at 12.5%, so 14.5%. But because a dealer did not have excise registration, he or she would have got input credit for the entire VAT component. So his net cost would have been 100 plus 12.5, 112.5. So to this he adds the 20 rupees of his dealer margin to arrive at his base as 132.5, on which he charges 12.5% VAT, and the consumer ends up paying 149.1. So in terms of numericals, it's 100 plus 12.5 takes you to 112.5. VAT paid is completely set off, so the net price for dealer remains at 112.5. The dealer adds a margin of 20 rupees. The tax base for VAT becomes 132.5, and the end user pays 16.6 of VAT to arrive at a price of 149.1. So the journey from 100 to 149.1 is comprised of excise which is completely non-settable and VAT which is completely settable. Now if you look at the post GST scenario, what is happening is that with this X factory price of 100%, 100 rupees, you have CGST and SGST of 14% each which will be applied. But the beauty of the situation is that this entire 28 rupees will be available for credit to the dealer. Earlier the dealer did not have an excise registration, so could have taken set off only for the VAT component but not for the excise component. But here CGST and SGST replace excise and VAT, and completely it becomes within the ambit. Now the dealer margin is 20%, so his net cost is only 120 as compared to 132.5. Now the only challenge here is that in case the rates of GST on this particular product for hypothesis sake is 14%, so then the consumer ends up paying 16.8 and 16.8 each as CGST and SGST. So here you look at, अरे GST में माल महंगा पड़ जाएगा, but that's not the idea. Idea is that this car might become costly given the factory owner, the manufacturer, does not have any further benefits from his supply chain efficiency, because there is this clear anti-profiteering clause with a clear sunset clause. So that is going to make a difference. So what you are going to have is input tax credit held in your closing stock if you've held it in the form of raw materials, semi-finished goods or finished goods. So the taxable supply is completely eligible for ITC. But if your raw materials, semi-finished goods or finished goods are meant for exempt supply, there is no input tax credit which is eligible. Plus you must have invoices or debit note, credit note or supplementary invoice for the same, and the date of the invoice must be before 12 months. If it's after 12 months, sorry, just liquidate that stock within 30th of June. So the scenarios here is, one, I have the stock which is within 12 months and I have the invoice for it. So what is going to happen in the post GST scenario is that this 12.5 of excise which I had paid, I will get a complete credit of this excise paid. VAT 14.1 under all circumstances I will get because I have a VAT bill. So I end up charging CGST and SGST from my consumer because the stock was held before 30th June and it is sold after 30th June. So a consumer pays 153.6. So this is the complete credit. Now there are scenarios where the dealer will not have documents. So then what? So there is the 60% deemed credit in case the CGST dues exceed 18% or is equal to 18% and 40% deemed credit. Now deemed credit is against CGST. It is irrespective of the excise component because you anyways do not have anything to prove it. So what does the act say? A registered person who holds stock of goods which have suffered tax at the first point of their sale in the state and subsequent sales shall be allowed to avail input tax credit on the appointed date in respect of which he is not in possession of any document evidencing payment of the value added tax. So such credit shall be allowed at 60% and 40%, which we have already discussed. Now how does that boil down in practicality? So in case I have paid excise duty of 12.5, what I will need to do is to continue to sell it at the same chain which was there, collect 16.8 as CGST from my customer and 40% of that will be a deemed credit. It is not contingent upon this 12.5. It's 40% of the CGST which I actually collect for scenarios where the GST rate is less than 18%. And in case GST rate is 18% or more than 18%, this deemed credit becomes 60% of 16.8, that's 10.1. So in the process what happens is that this differential is my notional loss, 12.5 minus 6.7 and 12.5 minus 10.1. The sad part is that if stocks is older than 12 months, then there is zero set off for excise. So it completely becomes a loss for you. So therefore friends, if you've got stock which is more than 12 months old, please liquidate that as soon as possible before 30th of June. Now this same no documents thing, in case of IGST it's 30% and 20% as deemed credit where tax exceeds 18% or if it is below 18%. Now the government is going to refund 100% excise for goods which cost 25,000 or more and bear a brand of the manufacturer. For example, a Samsung TV, a Whirlpool fridge, a Maruti car chassis. For this, the manufacturer can issue a credit transfer document as evidence for the excise payment. What's the time limit? 90 days. After the implementation of GST, please file a declaration within 90 days in form GST Trans 1 duly signed on the Common Portal. That's how. It's as simple as this as far as the act is concerned. Practically there will be challenges, but let's hope for the best. Any questions, please leave behind in the comment section below and I shall be happy to answer them.